Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we wrap up the day and the week. What a day it's been. And we were talking this morning about assuming the brace position given what had happened on Wall Street overnight with those sharp falls. More muted on the local market. We look at the CBO 200. Looks like it's going to finish down 1.2%. A little more exaggerated of what we've seen on the ASX 200, which is down almost 1.5% at this point. But given the size and volume of those falls, it should be no surprise that every sector has finished in the red. And, well, in fact, that's essentially seen the market fall to a 4-month low. It is a broad-based sell-off or sharp sell-off, as we can see there. A lot of this stems from concerns about interest rates, both here and in the US, not falling as far as expected, certainly in the near future. Questions remaining, particularly in relation to the Fed's next meeting in December, with more hawkish speak coming from some of those Fed members. So it does prompt the question where to hide. Do we become more defensive? We have seen that rotation on Wall Street in particular out of tech stocks into more defensive plays and cyclicals. And meeting minutes, just looking ahead to next week, we will get minutes from the meetings of both the Fed and the RBA, perhaps colouring some further clues there as to what they are likely to do in forthcoming meetings. Well, let's now get to those sectors. As I mentioned, pretty much every sector finishing in the red, led by tech. That has been the worst performer. WiseTech among them, off by 4.5%, Xero, which was already under some selling pressure over the past couple of days off the back of its results as well. Elsewhere, the financials also in focus there, given what we've seen with the broader market. So ANZ, the worst of the big four. And lithium, that's been outperforming the market of recent times. That's as we see the lithium price at more than 12-month highs. So once again today, we saw PLS finish in the green. Core Lithium updated the market today, and the market liked it. One of the more outstanding stocks, it's up 8%. And a quick look at energy. That is also mixed at the moment, with the oil price overnight up around 0.5% or so, bucking the trend we saw on the previous session where it fell some 4%. So Santos, Woodside and Kroon all finishing in the green. Let's get to the top stories of the day. And Rio has signed a 15-year virtual power purchase agreement with Terragen for its Kennecott copper mine in the US. In Europe, Vulcan Energy appointing ABB as its main electrical contractor for phase 1 of its Lionheart project in Germany. At home, Virgin Australia saying it's continuing to experience strong demand so far this financial year. And Ramsay Health Care's European subsidiary Ramsay Santé has released its quarterly results, saying revenue increased more than 2.5% over the quarter. Lendlease saying it's waiting for the finalisation of 3 large property sales before launching an up to $500 million share buyback. Well, among those stocks I mentioned there, Virgin Australia out with its results. Let's get some further detail on that. It was our stock of the day, and we got some comment there in terms of their opinion from Nathan Somasundaram from Data Analytics and Junbei Liu from TenCap.
I think with the update, reaffirms that the demand is still pretty good, and it is still a cozy duopoly there. Although there is a little bit of slowdown, as Qantas highlighted as well, across the corporate sector, but still pretty healthy. And the good thing for Virgin is that the growth is actually very strong because coming from the cost efficiencies. So with the update, I think highlight things are still pretty good. Both Qantas and Virgin, actually we got buy on both of them. They both look very, very cheap. Based on the growth they will deliver for the next 12 months, I put them both on a buy.
I think when markets are relatively optimistic about a sector, it always worries me. I think the outperformance by Qantas has the market very optimistic about the sector, but I think the cycle might be relatively negative. So I'd be a bit careful here. We're not in the travel business, so I wouldn't be chasing airlines. I know Warren Buffett has always said, you don't want to invest in airlines, and then he broke that rule and went back in and lost money there too. So even the great ones lose money in the airline. It's a tough business, so we're staying out.
Well, let's now unpack what we've seen across the week. Joining us, Shane Oliver from AMP. Shane, welcome back to catch up with you. So let's take a look, obviously, what's played out, particularly with those risk assets, most notably in the share market. Over the past 24 hours, we have seen those sharp falls. What do you see as the catalyst triggering that selling?
I think the basic factor driving markets here in the last day or so has been interest rates. Firstly, in Australia, we've had those stronger jobs numbers, which has further dented prospects for RBA rate cuts. And then in the US, we've had some Fed officials. There's a bunch of Fed officials out there, and that creates confusion. But the Fed officials who've spoken, there's been about 3 or 4 of them, have sounded somewhat hawkish, suggesting that they think rates should be left on hold for a period. And that, of course, has led to a rethink about how much central banks will cut interest rates. And so consequently, we saw the US share market fall very sharply overnight, falling back towards its lows of a week ago. And likewise, the Aussie share market's been under some pressure as well. So I think that's the main factor here. And of course, behind all of that is the concerns about valuations for US tech stocks. But I think the main factor in the short term is just the interest rate story.
So concern perhaps this may be the beginning of some larger downturn with potentially a correction. That's certainly a bit of the buzz at the moment. Although taking a look at the last time I looked at futures out of on Wall Street, they were pretty much flat. Nonetheless, what do you see as the positives at the moment, Shane? Now, clearly the US government shutdown is over. History will tell you equities have actually benefited after those events, and also the factor of seasonality, given we're heading into Christmas. Or, I mean, will Santa arrive with a rally this year?
Well, I think they're 2 key positives. The shutdown is over. History tells us that markets rally after they come to an end, as the economic data starts to flow again and things pick up. And as you say, we are coming into that seasonally stronger period that normally gets underway, particularly through November and then goes through December into January. The so-called Santa rally is part of that, and that's on the back of less capital raisings as we go into year-end, people investing year-end bonuses and so on. And I guess optimism about the new year. So those things are clearly there. I think central banks probably will still cut interest rates as well. By the way, you can see the seasonal pattern there on the chart. They're seasonal indexes for both the US and Australia. You typically see that weakness into September, October. Didn't really see that this year. And then you see that strength starting around October, November, going into the early part of the new year. Then everything is honky-dory out to around July, and then the whole cycle repeats again. Doesn't always happen every year. Other factors can overwhelm that, but history tells us that typically you see strength through November and December. On top of that, I think central banks will still cut interest rates. The Fed probably will still cut rates. I think they probably want to sound a bit more equivocal at present, just to give more scope to review things coming into that meeting in December. But that meeting is still a way off before we get to that point. And as we go through next year, I think the Fed will cut interest rates further as US growth remains a little bit sluggish, but more importantly, as inflation comes back down, as the tariff impact works its way through. Then you've got the fact that profit growth in the US is now almost at the end of the profit reporting season, and profits have come in around 15-16%. So we're about 92% complete. We've still got NVIDIA to come next Wednesday, I think it is. But the overall picture is for profit growth, which is roughly double what had been expected about 4 or 5 weeks ago. And likewise, when you look at Europe, when you look at parts of Asia, profit numbers coming out of those parts of the world have also been a little bit stronger than expected. So there's a bunch of positives there. So main negative, I guess, is just valuations. That's probably the main negative, and worries about a bubble. But those positives are quite solid, I think. And therefore, I think even if you see more weakness in the markets in the short term, it's unlikely to be a major fall, and then you can get that rally into year end. Next year, I guess there are some reasons to be a little bit more concerned because it is a midterm election year in the US, and history tells us that they can be quite volatile. In fact, if you go back to 1950, the average top to bottom fall in the US share market, or drawdown or correction, if you want to see it that way, is about 17-18% in midterm election years back to 1950. So that year is known to be a bit rougher. In the near term, though, and this is just one other positive worth mentioning, last week we saw those elections in the US. Republicans didn't do so well. Democrats did very well. Focus was on the cost of living. A lot of people who switched to voting for Trump away from Biden and the Democrats swung back towards the Democrats because they're still hurting on the cost of living. That means Trump is going to be under pressure, and he's going to focus on measures which help US consumers, cost of living sort of measures. That's why he's been talking about a 50-year mortgage, totally stupid idea, but anyway, that's why he's been talking about it. He's also been talking about tariff rebates, which sounds contradictory, that he's going to give money back to US citizens, even though they're paying for the tariffs in the first place. But nevertheless, he's going to have more of a focus on cost of living measures to help spending in the US, whereas this year a lot of the focus has been more negative in terms of tariffs.
So, Shane, as you said at the top there, perhaps investors fretting about the prospect of fewer rate cuts than anticipated. Let's take a look at the RBA, what it's likely thinking is, particularly in the wake. Obviously, we got a couple of weeks ago, we got that higher than expected inflation read. When we look at its dual mandate, jobs is how it's trying to balance that with inflation. The outlook there was some concern. We're seeing weakness here. Yet then yesterday, we got that read on employment, the unemployment rate moving from 4.5% to 4.3%. How are you seeing it at the moment, and particularly what the RBA needs to consider?
Well, it's kind of confusing. It seemed all fine till I went away on holidays. Then suddenly we get higher than expected inflation, a lot more hawkish comments from the Reserve Bank, and now I just got back and suddenly we've got stronger jobs data. So it does seem somewhat confusing. And I think most economists have now given up on further rate cuts. But we're in the camp that says, well, we probably will still get another cut. But given the RBA's current mindset, it will take a while for them to come round to that view. If you look at that chart there, yes, it was true. Unemployment fell back from 4.5% to 4.3%. But the pattern over the last couple of years has been you get two steps higher on the unemployment rate, then it comes back for a couple of months, and then you get another leg higher. And the broad trend in the unemployment rate still remains up. Likewise, when you look at annual growth in hours worked and employment, the green line and the blue line, you can see there that the trend is still down. That we are still seeing a slowdown in momentum in employment. We're also seeing a transition from growth in jobs driven by the care economy, by government spending, basically. That looks like it's slowing down, and it's unclear as to whether the private sector will fill the gap. And finally, when you look at things like job ads, the ANZ job ads survey, and so on, they're pointing down for jobs growth, that they're in a downtrend, suggesting that jobs growth will slow a bit from here. So my take on it is that it's very hard to see the RBA moving as early as December. Likewise, probably not going to see enough for a move in February. But providing we do see somewhat cooler inflation numbers, and I think we probably will, and the unemployment rate continues to trend higher, then we probably will still get another cut in rates next year. But it may not come till May or thereabouts, assuming the Reserve Bank continues to focus on the quarterly releases for the CPI.
All right. Well, Shane, listen, learn, don't go away again, because confusion clearly reigns when you do.
Thank you.
Thanks for joining us. Enjoy your weekend. Thanks for joining us, AMP.
Thanks, Andrew. Take care.
All right, let's return to the market then. Very negative day as we've seen. Let's get across the movers there. Look, not a lot in the green, but among them, Drone Shield, it's bounced back. Well, I guess relative, isn't it, given how far it has fallen. So looks like it's going to end about 4.5% higher. Orica, off the back of its well-received results yesterday, continued to move higher. Domino's, Santos, Karoon Energy. In fact, energy is now the one sector looks like it's going to finish in the green. On the negative side, well, there are plenty, of course. Let's take a look at the worst among them, those tech stocks, with Megaport losing more than 9%. Hub24 is on that list as well. Catapult has come off. Codan, Life360, another of those tech stocks under some selling pressure more recently. Taking a look at the small caps, Ecograph has shot out of the blocks today, up 20%. Havilah Resources, another positive move there. Lake Resources, Webjet's actually on that list as well as Finder, I should say. Negatively, let's take a look. And Rox Resources, 15%. Loxley Resources also down, along with Peninsula. So to the calendar tonight, we get the EU trade balance as well as economic growth figures. And from the Fed, more Fed speak, with including Raphael Bostic, who has announced he was going to retire in February next year. Now, next week, we get the beating minutes from both the RBA and the Fed, and importantly, locally, we do get the wage price index for the September quarter, also some global PMIs, and among those companies with earnings updates, New Hope, Elders, New Farm, and James Hardie. So let's recap. SIBO 200 looks as though we're finishing down 1.2%, and on the ASX 200, a little more exaggerated. It is down. Well, it's actually come back a little. It's currently down 1.36%. That is the COB. Thanks for watching and listening, and you can join us again on Monday.